All right. Hello, everyone. Good evening, good morning, or good afternoon. Depends on where you are. Uh, Today is the 12th of February. And the last time we were discussing anything, we were discussing supports and resistances, how to trade using certain levels. What I did not discuss then was momentum and how it is used in correlation with the price in order to predict the price, in order to call targets, in order to call it change in the trend. That's the key here. Also, by the way, I'm just gonna switch up the template a little bit. I got a little bit of feedback from people that said that they could not see the screen. Let's change this. Yeah, that's much better. Right? Let's just remove everything for now. So this is the price itself, right? On its own, it's supposed to tell you where we're going to bounce and how we're going to bounce. This is the daily chart on Bitcoin from Coinbase. There's a little bit of disturbance here in this region. Apart from that, it's a good chart, so we can make use of it. That's much cleaner. All right. So, what are oscillators and what are they supposed to do? Right. So I'll be discussing the very first oscillator, the most common, the most well known. That's the RSI. Right. So you can go in indicators and just type in RSI and select relative strength index. Right. So relative strength, and I'll just switch on the default settings for a minute. Oh, I have it saved at default. Okay. Right. So the RSI, or relative strength, measures certain periods in the past versus a certain different amount of periods in the past, judging how the strength has been over the price, as in say this period and this period. How has the price changed? And it gives you an index of how much of a difference there is, indicating the underlying buying or selling strength within the price, right? And there are two regions essentially that you need to take care of. The first region is this region, from the 80 to the 20 in the RSI, right? And the other region is from the 20 to 0, right? There are two regions. So these regions are known as overbought and oversold. Anything above the 80 is known as overbought, and anything below the 80 is known as oversold, right? So going strictly by the book, the RSI is supposed to give you signals of A1, where the price is oversold, and overbought, where you can essentially see where the price is being sold into. Oversold meaning that there's too much selling, it's not sustainable. And there's a potential change in the trend that's about to come, right? and overbought indicating that it has been bought into too much and the price is simply too high to be sustained. And a reversal to the downside is coming. Simple enough. And how do you use this to your advantage? You can essentially start buying whenever the RSI goes below 20 and sell it at the overbought region or just below it, right? So this works in most cases. I'm going to show you an example or several examples from the daily chart where I'm going to take the example of this particular dip here, right? And keep in mind, this is not intended towards margin trading at all, since margin trading has a far higher risk. But from this region to this region, right? You would be buying everywhere from here to here. So essentially, this was the entire dip, right? But notice how the next overbought is below where you would start buying. So your buys would be scaled in heavily towards the bottom. That's how you're supposed to do it. But from a layman's perspective, this isn't helpful at all times. However, in due course, there was a dip here where you could have bought, and then it continued upwards and eventually above your buying in price, right? So that's how you buy using the RSI. And here is a decent example where there was a heavily oversold region for, say, how long was that? That's about 2.5 days, 2.5, 3 days, right? And the price immediately bounced back much higher. But the trend itself plays a massive role in determining where you should buy and where you should sell. Typically, you should buy into a trend when it's on the uptrend and it's dipping on the RSI, right? So if the trend is on its way up, essentially wherever you buy on the oversold region is going to turn you a profit much quicker. One second. Right. So in an uptrend, wherever you buy, it's going to turn you a profit much quicker. That's also true for buying the top, by the way. So if you bought in a top at say 7,000, that turned you a profit anyway in about 18 days, right? And this changes as a downtrend begins. And this is a very good example of a downtrend. So you can draw a downtrend resistance. Essentially, this is where supports, resistances, and trend lines come to play, right? So this is an obvious downtrend, and this continues a little bit more steeply, right? In the process, where would you short using this indicator? You would short essentially anywhere where the indicator is asking you to short above the overbought region, right? And this is the most helpful when we're in a downtrend, selling the overbought. So here we were highly overbought and eventually it go down to the downside, right? On its own, it's pretty immune as an indicator. It's very good if you know what you're doing, if you are good at managing risk, if you've identified the trend, right? But without an established trend in a sideways market, say somewhere here, but the price isn't moving as much, right? Somewhat in an uptrend, but let's take into example this market where the high is here, or let's assume a slightly more sideways market. So say if this was your swing low and this was your swing high, that's an $87 difference in a span of how much is that? It's about, yeah, that's about 2 months, and that's Bitcoin, by the way, right? So this would tell you where to buy and where to sell. In a sideways market, both these things would work: buying the oversold and selling the overbought. But yes, the RSI trend following, right? As an indicator, it's supposed to tell you where you should buy and sell, assuming that you know the trend. It's not very complicated. It works on its own, and you can change the inputs by going here, and this is going to flatten it out a little bit. It takes into account that the periods before where the RSI is being considered, right? So here it's being considered as the previous 9 periods, which would give you far fewer indicators, signals, as compared to what it would do on a 2-period scale. So I typically use the 2-period, but it's up to you, right? Something that was brought to my notice was, and well, I should have seen this coming, but you can identify heavily overbought and heavily oversold regions. Essentially, you are optimizing your selling price or buying price using this. So the most recent example of this was right here, where the price was heavily oversold. That doesn't work always, clearly, because you're not supposed to buy in a downtrend, right? You're supposed to sell in the market, not buy in it. So this was an example where you should have sold because it was heavily overbought. And should the price cross over in this region, say tomorrow or day after, you'll be looking at if this trend is established on a lower time frame. So that's what we're going to do today as an exercise. We're going to identify the trend on a lower time frame. So this is the 4-hour chart. Notice how it's not been oversold for a long time, and it's been overbought heavily right here. It was sold into, brought into a low, right? So this was a good position for a short. But keep this in mind, like in 1x, we don't do hindsight trades. We do trades that are right now, that they're there or they're not, right? And any other kind of trades obviously don't work because then you're not actively trading it. There are no paper trades. I highly recommend you get a demo account if you're intending to get started on these things, right? It will give you an idea of when to use it and when to not. Typically, RSI works about 5 to 6 times out of 10. Assuming you're managing your risk, you're not over leveraged, stuff like that, right? All right. So yes, on a lower time frame, the trend is sideways. It's clearly not bullish yet. There are higher lows and higher highs, but this was only a $100 difference in price. It's not much, and there is obviously a lower high at this point, unless this was a retracement, which I highly doubt it was. If it's going to continue up or not, we'll see. But at this point, there is no obvious play except for a short here, which in 1x I called it and shorted on my own. But we bounced on that retracement. I'll come to divergences, but RSI on its own is a very uncomplicated indicator. It's not supposed to give you a lot of signals, but when it does give you signals, they're usually trend following, right? So here is a good example where the overall trend was up. And well, you couldn't have seen this coming, but the last 2 highs and lows told you to essentially buy the dip. And this was also, if I remember correctly, a 70% retracement. We'll come to optimal trade entries, all of that stuff later. Yeah, it was exactly 62% near about. So this would have been a good long either way. And it was also heavily oversold in the time, nearly heavily oversold, right? So is this incident, higher low, right? Which brings me to divergences. So this is how you make a divergence, how you draw a divergence. And this is supposed to identify if the RSI is able to indicate any strength in the trend that has changed since the last time, right? Oh, hang on. Okay. Fine. So this is an example. What kind of indicator? Sorry. Okay. Let's keep this open. By the way, just take this link in. It's probably in 1x somewhere. It's tagged somewhere. Just keep this open. And it'll tell you what kind of divergence you're seeing, right? And this is independent of the oscillator that you're using. So this in the case was a regular hidden bullish divergence where you're seeing a higher low on the price, but a lower low on the RSI on an oscillator, basically, right? This indicates that there is underlying strength, and the next dip, whichever it is, should ideally be long, because it will continue the trend upwards. It's trend continuation. So it indicates that there's extreme buying momentum compared to this dip. And it is higher just because there was enough buying momentum to keep the price from falling down even further to this level, right? So had the price fallen from here to here, you would have null and voided your trade. But once the price rebounded enough, say at this level, you would be looking for a long trade with a target that was higher than the previous top, right? This also works in other cases where we have a downtrend that's established. Let's see. Right, this is a good example, where you had a lower high on the price and you had a higher high. Oops. Sorry. Right, you had a higher high on the oscillator itself, which was indicating that the trend is about to, as a whole, is about to shift downwards. There's significant weakness in the trend. On the hourly time frame, this isn't directly useful. It's supposed to be indicating that the next high, wherever it comes, should be shorted, not the current high, not always. But on the lower time frames, on the 15-minute, for example, there usually isn't enough time for the price to react as hard, right? So here, for example, is a pretty good short indicator that you should have shorted right away, or ideally wait for the next stop, next bounce, and short it then. Because the previous, sorry, oh, hang on, this is not correct. This is what we're supposed to look at, where there was a very slightly higher high and there was a lower high on the indicator. This indicated that you should short the next bounce, no matter where it comes, and hope for a lower low than before. This works on all time frames, so yeah, just keep an eye out for those. These are very powerful as an indicator by themselves. There's one here, if you can see it. Another example of a regular, I believe. Yep, that's a regular bear divergence. Right. So these have determined the underlying lack of strength in the price action, that there's going to be a lower low eventually. Right after this low, there was a lower low. Right. So this is identifying the intermediate trend, as in the trend that is going to come right after. It's not supposed to give you any indication of what's going to happen at a longer time frame. It certainly is not going to tell you what's going to happen in the next, say, 10 periods. It's going to tell you what's going to happen in the next 3 or 4 periods maximum. It's not supposed to be used beyond that. Keep that in mind. So essentially, the RSI, the stock RSI, are very good scalping indicators on lower time frames. On higher time frames, they simply indicate strength or the lack of it. So this is the monthly chart. And I'll have to switch to candles for this for maximum effect. Yeah. There's something that you need to keep in mind for the RSI, that there is one line here that you need to take care of. That's the 50 line, right? So whenever the price is crossing from above to below the 50, the average of the, or rather the middle of the RSI, it's supposed to indicate that the trend is going bearish and is going to stay that way for a while, right? Here was a good example where the price went bearish for a couple of months, right here. And it really hasn't happened since until now. Also, these candles have to close in order for these to fully play out, right? So in order for the RSI to close below 50, this candle has to close lower than this candle, essentially, right? So the month of February, for example, if it stays below the month of March, that indicates a long-term bearish momentum. And it's the other way around for a bullish indication, that eventually when the price is supposed to cross up from the 50 from below, it's a very bullish indication on higher time frames. On the weekly, this is even more clear, where you are seeing trends change. And this was a very good indicator, by the way, at the time, that the trend is about to start changing. And it crossed back a little bit for 1 week here. And then at this point, by the way, Bitcoin is a very good buy because it's heavily oversold on the weekly chart. From fiat, by the way, obviously not at a margin perspective. Margin, you typically are dealing with higher leverage, so the price change itself could cause you significant losses, right? So yeah, that's the RSI. The next indicator is the stock RSI, and it's a derivative of the RSI and the stock, right? Where there are essentially two moving averages instead of a single line that are used, right? And these are from different periods. I'm not going to go over those. They're very simple in their use. What time is it in New York? It's just 7:30. This is a bit early to have a live stream, I guess. Nearly no viewers, 8 people. But thanks for watching in, guys. So the stock RSI is where the fun stuff happens, because this gives you far more indications of the price and what's going to happen in the price, right? So this is a good example of what's happening, where you had a higher low than before, right? But this might be invalidated because there has been a nearly equal low that didn't close as well, but on the weekly time frame, you're seeing a hidden bullish divergence. But apart from that, why is the stock RSI more useful than the RSI itself, right? And also, I'll convert this to 95.5 because that's the setting I prefer. Only when it's above 95, I call it overbought. Otherwise, call it oversold, right? So whenever, and here the blue is the faster moving average, and the red is the slower moving average. Whenever the blue crosses over the red, essentially this is a death cross, and I'm going to explain this in with the example of the 50 period and the 200 period moving average. And if you do not know what moving averages are, like, you can just Google this after you watch the stream, or if you're just starting to watch the stream, I highly recommend you pause the video here and go look at it, because moving averages are fundamentally something that I cannot explain directly right now. At least in this video, it's not supposed to be related to this, but advanced concepts of moving averages is something that you can understand fairly quickly. Okay, so there is no. Let's go to the daily chart. Right. So what happens when one moving average crosses over the other, right? And why is this particular moving average any different than those? Two reasons. First of all, these are much faster moving averages. This, in case, is I believe they're closer to being 3-period and 5-period moving averages, right? I'm not sure about this. Just go look it up. And in the meantime, these moving averages are very slow, right? But on lower time frames, what do they indicate? And why are we supposed to use this right here? When a faster moving average falls below a slow moving average, it's known as a death cross, because the current time frame, right? This right here is a good example. The current time frame, or rather the moving average that is fast, has changed its trend already, and the moving average that is slower is supposed to follow it eventually. In the case where the price is the same and stays the same for a long time, all moving averages are supposed to converge. But because the price changes so frequently, the faster moving average is it oscillates faster, right? So in this particular case, the 50-hour moving average crossed below the 200-hour moving average, right? And what does this indicate? It simply indicates that at this point, the trend has gone significantly bearish, and the opposite holds when there is a golden cross, right? So golden crosses are when the 50-hour moving average or the 50 period moving average is crossing above the 200 period moving average. And the reverse is true for the red cross, where it's crossing from above. The 50 period moving average is crossing from above the 200 moving average. It indicates a significant change in trend. So, for example, in this case, how would you use the moving average to place any kind of move? Once this crosses, right, and it would have been at this price point right here. So once it crosses, you're supposed to look for a dip to long, right? And eventually what you'll find is once it crosses, once this golden cross happens, the price usually finds support at the 50 period moving average and then continues up for a while. So your take profit is supposed to be wherever you want it, and other indicators are supposed to indicate that. This is an example of an indicator that would have given you decent entry. So right here, for example, is the dip, and it was heavily oversold on the stock RSI. The same principles apply, by the way, from RSI to stock RSI. The entries are the same. Also, keep in mind that the RSI is trend following, but the stock RSI is faster than the RSI giving a reaction. So you'll get more indications from the stock RSI. So this was a buying opportunity right here. And where would you have exited? Somewhere here, right? But again, this would have not been a good exit because it eventually found a higher low. The price, it found support at this level, right? And that was because of the support of the moving average itself. There was plenty time for you to re-enter after you saw that the price had eventually found support, and you could have longed wherever the price went overbought, right, and sold at that level. And the reverse is true in this case, where you essentially wait for a death cross. You wait for the price to test the death cross and eventually break it just a little bit, right? And then wait for an overbought opportunity in order to identify the trend and eventually follow it. And that's what's been happening ever since, right? So this particular case is an indicator where you should not have longed because the price kept falling. There was no bottom. The price kept falling right below the 200-day moving average, 200 period moving average in this case, right? So what's going on right now? Several things. First of all, on the hourly chart, we have a golden cross right at this level, right? So once you saw this, you are looking for an indicator or a change in momentum to long, but that never happened because the price never truly tested the 50 period moving average until now, by the way, until very recently. It found some support at this level. That's a pretty good sign. In the long term, this typically indicates that until there's a death cross somewhere in this region, that the price is most likely going to continue upwards. And that's indicated very well by the increase in the speed of the slope of the moving average, right? So as you can see, the moving average is sloping slightly upwards right now. But the 200 period moving average is still going lower, right? So what you do not want, in the case of a bullish position, is the price to eventually cross below the 200 moving average. All of this applies to all time frames. You can go to the 15-minute and play the same thing. That's weird. Okay. So, yeah, the 15-minute just had a golden cross, right? And this should have given you right here, should have been an indicator to long. Where would you have longed? Essentially, ideally, you should have longed the test of the 50-hour moving, so 50 period moving average right here, right? Hang on. So yes, that's about it. That's as far as it goes for moving averages, right? And by the way, that short that we had, that's why I exited. I was expecting a bounce somewhere in this region, and it happened a bit earlier than I thought. I'm expecting that on the 5-minute chart, it would have been a clear bounce. Or actually, it broke right through. So let's see what happens. The stock RSI also gives you the same indications for its own moving averages, right? So here's an example on the 15-minute chart right here. And this is also an example of a bearish divergence on the stock RSI, where you had a very clear divergence because there was a higher high but a lower high on the oscillator. And one more thing that happened was that on the stock RSI, the 50, or rather the faster moving average, had crossed below the slower moving average, right? And when did it cross back? Right here. And this gave you a bearish divergence, which means that this was a pretty good indication to go short, right from here to here. And you would have exited at somewhere at this level where the price went extremely oversold, right? And now it has crossed back. So this is a golden cross on the stock RSI. This is how you use moving averages in direct correlation with stock RSI. Simple enough. We'll move to the MACD. If you have any questions, it's a good time to ask them now before we start moving on to the MACD, because the MACD itself will take some time. All right, let's move on. Then a lot of people aren't awake right now. It's a bit early for me to start a live stream. What I'll be doing though, I'll be scalping on the live stream itself. Right now is a pretty good time to do it. And plus, I'll be taking some questions as I scalp. All right, so yeah, that's it for the stock RSI. Now we move on to the MACD. I don't have it favorite because typically I don't use the MACD as much. The MACD itself is very similar to the stock RSI in terms of its moving averages. The only way it differs is that the MACD does not have a higher or lower bound. The stock RSI and RSI both have a higher bound of 100 and a lower bound of 0, right? But in this case, 0 is the median, and the price can also hit either side of the 0, right? So how do we use this in correlation with the price itself? And I'm going to turn on the moving averages for this and move to the line chart. So wherever the price is crossing below the 0, and I'm going to the 1 hour chart for this. Let's see. Cool. So wherever the price is going below the 0, this indicates significant bearish momentum, right? And ideally, you should go short right here. Wait for a slight bounce and then short it. And where will you exit that short? That short exit should be wherever the faster moving average is crossing over with the slower moving average. So ideally, your short should have been wherever the faster moving average or the slower moving average started going below the 0, right? They went to 0 both of them went to 0 together. So say you shorted at this level, and your stop loss would have been at the previous high, for example, and this here was your stop loss. Gonna dull these lines a little bit, so I'll make this right. That was a short entry. So where would you have taken profit? Your take profit would be wherever this price cross happened, right? So it was right here at this level, roughly. And you could have waited a little bit, sure, but there's no point, right? There was a low. And now the trade itself, as you can see, is not a very profitable trade in terms of the RR, in terms of the risk reward ratio, which is why you should not use the MACD by itself. The stock RSI is a far better indicator. And for entries, you should use fibs or support resistance, whichever you feel is the most ideal, right? But ideally, if you waited for a short entry, would have been here. with the stop loss at this level. Assuming you saw the change in momentum using other indicators, your short exit would have been either here or here, which is not really a bad trade, right? So yeah, that's one way to use the MACD. The other way to do it is to wait for the moving averages to cross below zero, right? And this indicates that the bearish trend is coming to an end. But where did it start? It was when the faster moving average moved below the slower moving average. So that was right here, right? And this would have been an indicator to find a dip to long. And it almost failed here, where it was right about to cross below it. But other indicators were telling you to wait for an opportunity to long anyway, right? So say you had longed at using this indicator, you would have longed somewhere at this level, and your stop would have been at the previous swing low, which would have been right here. Where was your exit? Your exit isn't here yet, right? And the price, the moving averages have already crossed below, oh sorry, above the zero. So according to the MACD, you're still in the trade and you're pretty much looking for an exit whenever the moving average crosses below. In my opinion, you should take profit wherever you feel that you've reached a certain point. So according to your risk reward, right? And I typically make 2:1 risk reward ratio trades. Your take profit already happened according to 2:1, right here, right? And you could have kept this profit for a 3:1 or more trade. That would have been fine too. This is how you use the MACD. It's a very conventionally free indicator. Does not require too much interference. Also on higher time frames, we're pretty bullish right now. As you can see, there's been a cross above the zero. This indicates that there's some sideways momentum and it's going to continue upwards for a while, right? It never went below the zero. Where it went below the zero was like far up right here, where it went bearish properly. And it recrossed at this level. So this would have been, let's see, this would have been an open short or close long, either close long or open short, right? And right here would have been closed or short, and here would have been your open short, and here would have been your close short at this price, right? So by itself, MACD is pretty powerful. Let's see how it works on the 15-minute chart. Right, so let's look for entries below the zero, wherever those happen, right? So this is one entry, open long here, take profit at this level, open long, take profit, right? So at this time, you should have been in a short trade, short term, which we were in 1x. I had already called that short roughly at 83, 8792. I had called that short and we rode it out for a while. So this trade hasn't really come to an end yet, but I had a premature exit because I'm waiting for a better entry. Plus, you should always don't double down. Instead, take some profits and then deleverage and add more to your position once you've taken some profit, right? So this is how it works. We can go to lower time frames. This works okay for scalping. This is a good example where you should have you can wait for a dip and long right here and wait for the moving averages to converge onwards and then exit. It worked here and every time before that, right? So what you need to do is you need to pay attention to the MACD very, very carefully. On higher time frames, that becomes less careful. And this is the 1 minute time frame. There's nothing useful here. Opening it for meme value, nothing else, right? So because it doesn't have an upper bound or a lower bound, it's not supposed to be used as a indicator of when it's overbought and oversold. It's rather supposed to be used as an indicator of where you should enter, exit, and look for positions, right? So right here on the daily, something that I was looking at yesterday, you have an indicator to open a long. That just happened yesterday. Oh, it was a couple of days ago, 3 days ago. It give you an indicator to go long, right? Using this in correlation with smaller term timeframes is very helpful. And this should not be taken lightly because crosses are very rare. And unless it uncrosses, right, it turns back and goes down. You should be in a long, like from this region already. So I'll come to talk about Bitcoin in the long-term perspective, but that's about the MACD. And that's about it for this video. It's fairly simple to use. If you have any questions, please just feel free to just tag me on 1x and ask them either right now or whenever you want to. That's fine. Also, one question that I received today was, I'm gonna read it out. Let's see. So people ask me where I learned all this. The truth is I've learned it over the last about 8 months. Very actively, I've been trading only recently. So this isn't something that automatically happens. It's something that you learn over experience. There's really no way out of it. If you're in training, you'll eventually have to learn these things unless you're somebody like a market maker who knows the events before they actually happen. And rather, these people make the events and not the other way around, right? So yeah, that's about it. I'll probably come back to have a live video for scalping. I'll be scalping basically, and you can all watch sometime later on, right? So yeah, really have a nice day. Take care. Oh, hang on, there's a question, I think. All right, so I'm getting a request to chart Lisk. Do that. Actually, Lisk has a take profit, close, long, and open short at on the 4-hour chart. And unless the faster moving average, and at this point it's not exactly a very profitable trade if it goes back above the slower moving average. So in my opinion, it's not a good time to buy Lisk. I would wait for this higher high to close, right? On the daily chart, yeah, there's a lot of room. There's plenty of room, but this isn't specifically indicating a trade. You had a long entry right here, right? So yeah. Perhaps there's something on the lower time frames, I'm not sure. You had a long, open long here, close here. That's not exactly a profitable trade. Like somewhere at this level, you'd be opening a long and exiting here maybe. Risk is like really close to its all-time high. I wouldn't think about longing here because technically a fib retracement. Okay. I'll wait like a few more days before I see any movement on Risk because I expect the price to fall somewhere to this region. Where I will decide to long or not, depending on other indicators. Thank you for asking, Dolvar. Right, so that's about it for this video. Feel free to drop me any questions, any problems if you have with respect to these indicators, and I'll be very happy to help you out. Thank you and have a nice day.